the Kenyan markets picture right now. Of course, looking at the macro picture, we've got the economy expected to grow by 4.2% this year. Are you as optimistic about the recovery process?
Well, it should recover. I mean, you know, the base of which it's coming from is very low. But I think one of the key problems that Kenya is facing, well, there's a few challenges. I mean, firstly is the food harvest. You know, again, it's looking very poor. It has a variety of implications for fiscal spending, for inflation, for potential weakness of the currency, and of course it will depress growth. The recent rainfall that's been happening will help, but I think it's too late to really help the maize harvest. Is going to help things like the tea crop probably. You know, so the tea crop this year is looking to be 15% higher, which is great news because tea is the largest export earner for Kenya. So that will help at least on the one side. You know, other problems, of course, you know, the global economy remains relatively soft, and tourism, which is another important earner, and remittance flows, which are both, you know, very dependent on international economic conditions. You know, as long as the global economy stays on the softer side, I can't see those variables picking up too much.
Of course, the other major concern is the fact that we have Kenyan banks not lending yet as easily as the central bank, for example, would like it to. We've seen the central bank slash interest rates in the past. We've got the MPC out with its rates decision this afternoon, and the consensus largely is that we're going to have interest rates kept at 7%. Your outlook on that front?
I would agree with that. You know, we saw a big adjustment in November from 7.75% to 7%, and that was in reaction to the new CPI number that had been released. So we saw the CPI coming up materially lower than what we previously thought it was. You know, the risk probably would be for some further moderate downward adjustment if that were to be the case. And there you could, you mentioned credit extension, which was running over 30% a year ago to private sector, is now at about 10%. You know, and that does concern the central bank. We saw the GDP data for the third quarter come up very soft. You know, that said, inflation seems to have stabilized. Money supply seems to have edged a little bit higher in recent months. You know, so it's not such a compelling argument for them to add further stimulus into the system, because remember the fiscal side is pumping lots of money into the system as well. So I would go for an unchanged rates with a 30% chance of a further moderate downward adjustment.
So in line with consensus there, let's bring in our broker from Nairobi into this discussion, Gachara Nganga. He's an investment analyst with CFC Stanbic Financial Services, joining us live from our studios in Nairobi. Let's, Gachara, get into this conversation. I mean, just how closely is the market watching this interest rate decision this afternoon?
In the past, we've seen that the market has probably discounted the information to prices before the MPC even gets a decision out. And the problem has been is that even after the MPC decisions, we rarely see interest rates come down. So the banks are not really using it as a guide or to direct them in terms of how they're going to lend. They try to look at a bigger macroeconomic aspect. How is the risk appetite in the country? How are the economic fundamentals looking? What is the chances of them recovering once again they pay out their debts? What are the service ratios for loans at the issue? So I think until the macroeconomic aspects improve, the CRR won't really be a guide for our markets. The only thing that seems to happen is that interest rates on government debt have gone down. But in terms of real impact, in terms of lending to the private sector and especially to private households, there's been marginal impact on that.
And in that context, we've got some of the banks really stealing the spotlight. We had two banks in particular surface as the biggest gainers amongst African stocks last week. Of course, Equity Bank topping the leaderboard, recording a 20.98% gain to close at 16 shillings 80 last week. What's driving interest in Equity Bank specifically?
What we believe is happening is that most of the information about last year's results, which are going to be released probably in mid-February and early March, have already been factored into prices. So investors are looking towards the new year. And have you seen, and as you said, there is good economic data coming in. Their projections are a bit healthy. And also the psychological aspect that it's been raining and short cycle products are a bit cheaper. And given the fact that inflation basket will be recomputed, we say that people are starting to look at a better year than it was last year, seeing that it was we're also coming from a very low base. So it's expectations for this year that have started being factored into prices. And that's the reason why you're seeing the rally mostly across the sector, but factored on Equity Bank, because people believe that once it comes and once credit purse strings are open, that Equity will get a huge chunk of the uptake of debts.
Mainly supported by foreign investors, though, and it seems to be a different case that's supporting KCB, which is the second counter to to gain recognition in Kenya. It racked up 9.5% gain to finish at 22 shillings 75. Just looking at that stock, I mean, what's driving interest there? Because that interest is mainly being derived from local investors.
Actually, if you put it in perspective and you look at KCB and Cooperative Bank, we've seen a rally in both stocks, and given the fact that most foreign investors actually do not look towards KCB, and even more so have seemed to shun Coop Bank, yet the introduction of agency banking also makes the structure of KCB and Coop Bank a bit more attractive. So in as much as Equity Bank has gone to the foreigners, since the fact that the banking sector is seen as a growth sector for this year, and the fact that KCB and Coop are not really been highlighted by foreigners, then local investors are coming in to pick up the slack and capitalize on gains there.
Yeah.